what's good, YouTube? It's your boy Charles Enoch. You already know we're back with another Invest in Myself episode. So let's run that intro. Okay, so today I want to go over how to pay off your loan using a line of credit and then using your line of credit as your bank account and quickly pay that line of credit off, saving you interest. So this explanation is going to be very simple. We're going to start from the beginning. It's going to be a very small loan, and we'll eventually work our way up to paying off mortgages in 5 to 7 years. But I definitely want you guys to get the simple concept of what we're doing, how we're chunking through the amortization. So this video will have two parts to it. So part one, which we'll be going over today, is how to pay off the loan pretty much using the velocity banking strategy. So part two, we'll go over how to calculate simple interest when we're using that line of credit to pay off your loan to figure out how much it's going to be charging you in interest. We pretty much want to figure out how much you paid in interest when you moved your debt from the loan to the line of credit. So part one is going to be more mechanics. In part two, we'll go into more of numbers. All right, so before we get started, I just want to congratulate the YouTube channel for reaching over 700 subscribers. The goal is to try to get 1,000 by the end of the year. So if you are new to the channel, go ahead, take a little time, hit that subscribe button for me. Also, if you enjoy my videos, please remember to smash that like button for me. Make that thing turn blue. It helps me reach a higher audience base, and I really do appreciate the people that take the time to do so. All right, so I got the whiteboard in the back, so let's get to it. All right, so we're at the whiteboard and we're going to get straight into it. So this part right here, we're just going to be looking at when somebody pays a loan, what kind of goes on in regards to the interest and principal. So let's get to it here. So we have the individual, their income is $3,000. Their expenses are $2,800 a month, which means that they get a cash flow of $200 every single month. Now, their loan is $3,600, and the minimum per month that they need to put on the loan is $100. Now, when they're putting the money on the loan, $80 of that goes towards interest and $20 goes towards principal. Now, I know you're looking at me like, hey, that's a crazy high interest loan. And it really is. It's like a 27% interest loan. But hey, there are people out here that really do have these type of loans at that high of a percentage here. So again, we're not really worried about the percentage. I just want to show you when you're making your payment, how it's pretty much working, what's getting allocated to the interest, what's getting allocated to the principal. So let's just do a brief rundown of what goes on month to month here. All right, so let's briefly go over this here. Should be very simplistic. So we have the month of January. Remember that the cash flow this individual has is $200, and he's going to be putting all $200 onto that loan here. So at the end of January, we see the debt will be $3,480, and $80 of that goes to interest. So only $120 went towards the principal. So if we look at February, the end of February, it's going to be applying that same $200 there. So the debt's going to be $3,360, and the interest being paid would be $160. And let's do one more for March. We see that when they do that $200, only $120 is getting applied towards the principal. So that leaves it at $3,240, and we see the interest at $240. So we can see that, and we can see by the end of the year, the debt would still be $2,260, interest $960. So this individual is paying a lot of interest towards this high loan. So with velocity banking, we're trying to figure out how to cut all that interest and pay off this $3,600 quickly, because it makes no sense to be paying that much in interest. Now, one thing to note, just to be technical, with the amortized loan, now the interest, the first payment, it starts out where the interest, you're paying more towards the interest, and then it starts getting lower. So for a more realistic example, let's say January, when you put your $100 minimum payment, 80 would go to interest, 20 to principal. Let's say February, it goes down to 79 in interest and then 21 towards the principal. So the interest does keep getting lower. I just want to put it in really simplistic terms, but I mean, the interest, you would still be paying a lot in interest. All right, so now that we have, and we see a visual of the basic concept of how everybody just pays off their loan, let's take a look at the velocity banking strategy and how if we use a line of credit to pay that loan off and then pay the line of credit back, how that works. All right, so we're back with the same scenario, but we're going to be applying the velocity banking concept. So let's just kind of break it down here. So it's the same thing. The individual's income is $3,000, expenses $2,800, which leaves them at a cash flow of $200. Now the loan, remember, is $3,600. Minimum per month is $100. Remember how it's going to be allocated here. The interest is $80, and then the principal is $20. Now this individual has a line of credit for $6,000. Now remember, on the basic concept for velocity banking, your income is going to pay your credit is going to pay your expenses. So let's break it down and see how this is going to play out. All right, so we're in the month of January. If we take a look here, the end of January looks like this. So the line of credit, the $6,000 line of credit, would have $2,620 that is left onto the line of credit. Our debt for our loan would be $0, and the interest we have paid for that month is $80 on the loan. So let's see how that particularly happened here. So if we go to the equation, the loan itself is $3,600, and when we make a payment, $80 will be going towards interest. So what we're particularly going to have to do, we're going to have to use $3,680 out of our $6,000 line of credit, and we're going to apply that towards the loan. What that's going to do is pretty much pay the loan all the way off. And when it pays the loan all the way off, it's going to increase our cash flow by $100 and reduce our expenses by $100. And why is that? Because part of our expenses, the $2,800, was the loan, that minimum $100 per month. So since that's not clean, then we increased our cash flow and reduced our expenses. So let's go to the next step. So now in that month of January here, remember that this step right here, let's say apply January 1st before any of your income even came in. So in the month of January, on step 2, this individual gets $3,000 for that month. That's their total income. They're going to use that. They're going to put that onto the line of credit that they used here. So they're going to put $3,000 onto the line of credit. Remember, they took $3,680 off. So the line of credit will have $5,320 on it. Now, the next step, we would use the remainder income, which on this step, the individual doesn't have any type of remainder income. So it's $0. They use all their income and put it onto the line of credit, which is fine. So since we don't have any leftover income, our expenses will equal $2,700 for that month. Now, how are we going to pay our expenses? We're going to use the line of credit. Remember, the income paid the line of credit, and the line of credit will pay the expenses. So we're going to go down to this step. Since we have $5,320 onto the line of credit, we're going to use that to pay our expenses. This leaves our line of credit at $2,620 that is available. So this is how we're getting to that number at the end of January of $2,620 on the line of credit. We wiped out the loan, and remember, to pay off the loan, they had to charge us $80 for interest. So that's how January played about. All right, so let's look at the month of February. We're trying to pay off that line of credit here. So at the end of February, we're looking at a line of credit of $2,920. Remember, we don't have any debt onto our loan. We paid that off in full. And since we paid the loan off in full, the loan isn't charging us any interest. So let's see how we came about that number of $2,920. So remember, this first step is only if you have a loan. Since we paid that all off, we're just going to eliminate that first step here. So we're on to the second step here. So when our income comes in at $3,000 comes in every month. We're going to put that onto the line of credit. Now, remember, our line of credit was $2,620 at the end of January. So once we get all of that money in there, our line of credit is going to be $5,620. Now, we don't have any leftover income as of right now to put anywhere else. So we're going to skip down to this step here. So the last step, that $5,620 in our line of credit, we use that to pay our expenses off. Remember, our expenses are $2,700. Since our loan was paid off, it increased the cash flow and decreased our expenses. So when we do that here, we're going to be left with $2,920 left on our line of credit for the month of February. All right, so we're in the month of March. Let's see how it's broken down here. So at the end of March, we're going to be left with $3,220 onto our line of credit. Again, we know that we paid off our loan, 0 in debt, and 0 in interest since the loan is paid off. So let's go straight to the equation here, see what we're doing. So remember, we skipped step 1 since we already paid off the loan. Step 2, we're using our income, that $3,000 that we get, and we're putting that onto the $2,920 that was the end of February's line of credit balance here. So once we put that on there, the line of credit is now at $5,920, pretty much close to that $6,000 mark. Now, since we don't have any leftover income, we're skipping that step, going down to this last step. So our line of credit is $5,920 that we have on it. We use that to pay our expenses, the $2,700. We minus that here, this from this, we get $3,220 for the month of March. So we're slowly getting that paid off. We see that it's adding $300 onto the line of credit. So we're getting it paid off a lot faster. All right, so we completed the month of March. Let's look at the month of April here. So we know at the end of April, our line of credit is going to be $3,520. So we can see the trend is going up $300 onto our line of credit. So we're going to be able to pay that off a lot faster here. So let's jump into it and see what the equation is going to be presenting us for this particular month. So step 1, we're going to just eliminate that since we paid off the loan. We're going to go down to step 2 here. We're going to put our income in to the $3,220 here. So we're going to use our $3,000. We're going to put that into the line of credit. This will complete our line of credit and put it back to the $6,000. So since we have leftover money, we're going to have $220 that's left over. Now, what we're going to be doing with that $220, we're going to apply that towards the expenses. So when we put $220 onto the expenses, which are $2,700, we're going to be left with $2,480 for expenses. Now we're going to go down to the last step. Our line of credit is full, but we still have to pay our living expenses here. So we're going to pull some money out of the line of credit to pay off the expenses. This will leave us at $3,500 for the line of credit for the month of April. All right, so we're on to the month of May. So at the end of May, we see that our line of credit will be $3,820. Again, we already paid off the loan. There's no debt on the loan. There's no interest since we already paid off the loan. So let's see how we got to the line of credit for that $3,820. So remember, step 1, delete that there. We're on to step 2. We're going to use our income that's coming in, the $3,000. We're going to put that onto the line of credit. So remember, our line of credit was $3,520. We put $3,000 on that. It puts our line of credit back to the $6,000. And then we have leftover money, which is $520. We're going to use that onto our expenses. So we're going to pay off $520 of the $2,700, which leaves our expenses at $2,180. Now, to pay the remainder of the expenses, we're going to look at our last step. Our line of credit is $6,000. We're going to use that to pay the expenses, which will leave our line of credit at $3,820 for the month of May. Again, we see that every single month we're putting $300 onto the principal of the line of credit, which is making us pay off the loan faster. All right, so I think we have the gist of things, but we'll do one more month just to run through it here. So for the month of June, we see at the end, our line of credit will be $4,120, which is $300 over the $3,820. So let's see how we got it here. So again, step one's already completed. Step two, we're going to use our income, the $3,000. We're going to put that onto our line of credit, which will pay it off and put it back up to full to the $6,000. And then we use our leftover income of $820. We're going to put that onto our expenses of $2,700, which will leave us at $1,880 for expenses. Now to pay off the rest of the expenses, we're going to use our line of credit, that $6,000 that we have that's in full, and we're going to pay off the rest of our expenses for that month, which leaves us at $4,120. So again, we see how that methodology is going, $300 of principal every single month, which is going to allow us to pay that off quicker here. Now again, part one is pretty much just the mechanics of what we're doing. We know that for a line of credit, there is simple interest being charged. And a lot of people don't know how to calculate the simple interest, which we will be doing that on part two. So again, for part one, we remember that income pays the credit, pays the line of credit, and then the line of credit is going to pay our expenses. This will allow us to pretty much eliminate the loan, and then we're using our line of credit like our bank account. If you think about it, we're putting the money onto the line of credit, and whatever we need, we're just going to be using that to pay everything else. Again, hopefully this was a very simplistic breakdown. We will be tackling bigger loans like mortgage loans, car loans, etc. But it's always good to go back to the basics and see what we're pretty much doing. So if this video did help you, remember, if you're new, go ahead, hit that subscribe button, and take time and hit that like button for me. And if you found this helpful, go ahead and share that with others as well. And I appreciate you guys for taking time to watch the video. Definitely leave a comment if this was helpful. And again, I will catch you guys next week. Peace out.